Welcome to one more part on accounting the basics. At least with debits and credits, I will do more of these two tutorials. I think it helps students a lot. But I think this might be the last one on debits and credits. If not, certainly one more we can do. So let's pick up where we left off and let's work on this AED. Work off of, I guess, this LED. And let's remember what this is. This is just a tool to help us with our debits and credits, okay? And it's after eating dinner, let's read comics. We know that to increase an asset expense draw, we need a debit. To decrease asset expense draw account, we need a credit. Over here, to increase liability, revenue, capital, we need a credit, and then to decrease those we need a debit. And then let's do a transaction here, okay? Let's do purchased an auto. Okay, purchased an auto for $25,000, okay, $25,000. We're going to we put $3,000 as a down payment, and we will finance the rest, okay? All right, there's our transaction. Now we have to record this with our debits and our credits, okay? Alrighty. Step one. Now, step one was to figure out which accounts are affected. So we'll put down here which accounts, and we know what we're talking about, which accounts are affected, and let's look at those. So let's go back up here. All right, we purchased an auto. All right, well, I think auto is going to be certainly one account, because that's what we purchased. We put $3,000 down. Well, shoot, I know that's going to be cash, right? And then the last one has to be a finance, which has got to be notes payable. Notes meaning promissory note is where that came from. Promissory note. And what that means is usually when you sign, and not so much, I'm not, well, okay, well, the word note, coming from promissory note, is really the notes payable. And typically that's exactly what you're doing. You're promising to pay back a certain amount of money with interest. So that's where that came from. So we know that notes payable is a liability account because that's what we owe now. So step two, then, okay, I better hold on here. I better put this, let me just clean all this. Let me just clean all this up here. Okay, let me just clean all this up here. And let me put step two down here. So step, tool back here. Okay, so step two then is applying the AED-LRC rule, right? Or the tool. It's actually tool. Okay, we got our accounts. We purchased an auto, we put a certain amount down, and we financed the rest. Now, no matter how many accounts you have up here, and we could have 20, we could have 50, we know that our debits, all of our debits, have to equal all of our credits, no matter what. Okay, so that's every transaction, and that's no matter what. So let's see here. Well, let's work backwards in terms of how much cash and debits and credits and it goes where here. So let's take a look at the financed. We financed the rest, put $3,000 down. So note payable then has to be $22,000, right? So the question is, that's how much we're financing. The question is which side? Is it debit or is it credit? So let's go over to our tool. Are we increasing the notes payable account or decreasing it? And we're increasing it because we started at zero, right? We had no debt. We just bought this auto. We increased our debt, right? So that's an increase. So increase the liability, credit, and here it is, $22,000. Good. Now we put $3,000 down, right? That's cash. Now which side does that go on? Well, are we increasing or decreasing our cash? Cash is an asset. Decreasing it needs a credit of $3,000. Now, we can stop here because we know that our credits are adding up to the $25,000, right? That means that my debit has to be $25,000, right? So that means that this has to be $25,000. And let's see if that makes sense. I'm increasing an asset because a minute ago I didn't have one, now I got one, so that's increasing. Needs a debit to increase, there it is. And my debits equal my credits. There's a debit of $25,000 and there's my credit of $3,000, credit of 20. So I have a credit of 25, debit of 25. Okay? All right, let's do one more. We can do one more here. I just put the tool back up, AD, and pretty soon, you know what? You're gonna know this like you know your multiplication table, and you're not gonna need this anymore, which is the whole point here. It just takes practice. That's all it does. So here's my debit. Okay, here's my credit. Here's my credit, and here's my debit. Okay, let's take another transaction. Purchased supplies on account. $1,500. Okay, purchase supplies on account. Let's take a look at this on account. On account means this. This is what on account means. So I walk into, I don't care, Staples or wherever your favorite office supply store is, and I have a credit line with them. So what they've done is they've extended credit to me, right? So I can pick up whatever I want, say, $1,500 worth, and I don't have to I don't have to pay this now, right? I can pay it later. But I get the supplies. So I go in, I pick up $15 worth of supplies. Excuse me. They're going to bill me the $1,500. I'll pay it in 30 days or whatever. And I'm going to walk out with my supplies. Okay, so that's on account. And by the way, that works both for customers and vendors. So you extend credit to your customers. Your customers will walk out with, whatever your product is, not pay you now, pay you in 30, 45 days or whatever. And so that's on account. We'll get to a transaction like that, okay, to show you. In fact, if I have time, I'll do that after this one. Okay, so let's get rid of this. We don't need this. And we don't need this either. So let's get rid of that. Okay, or that. Okay, so step one, which accounts are affected? Well, let's see. Purchased, okay, doesn't help me. All right, supplies and on account helps me. So I know that one of my accounts is going to be supplies because that's what I purchased. Now the question is, what's the other one? And the other one is what we call accounts payable. Accounts payable, or shorthand AP. Okay, accounts payable. That's a liability account. That's for all my trade vendors and creditors, everything I use for my operations. Not a note payable that I just signed for the auto, but an accounts payable. This is, I'm going to pay this, within 15, 20, 30 days. Okay, this is my trade payables or accounts payable. Okay, All right, 1,500. So come back over here. Step 2, remember, is the AED LRC. Okay, supplies, increase or decrease? Supplies increased, so it's going to get a debit. Therefore, I don't even have to look, and I know this is a credit, but let's look anyway. It's a liability account. It increased. It's a credit. And do my debits equal my credits? They do. And look at that. We're starting to record. Transactions in accounting. Beautiful thing. All right, I think we can do one more. Let's do without the AED LRC. And let's say customer bought $1,000 worth of product. On account. All right. Step 1. Where are the accounts affected? Customer. That doesn't help, but it does, kind of. 1,000 worth of product. Okay, product revenue, right? Customer bought 1,000 worth of revenue. Okay, so I've got revenue. I just sold this customer something. So instead of revenue, most of the time revenue is just a category, and we'll call it sales or fees earned or something. Revenue, remember, is just a category. Sorry about that. I hope I didn't confuse you on that. Okay, customer bought 1,000 worth of product on account. All right, there's on account. This one is for customers. So it's going to be accounts receivable. All right, accounts receivable. All right, this is a little messy here. Let's take this out. It's a little messy. As a matter of fact, let's take this out and take this out. Okay. And let's put this is real important. Accounts receivable, right? And then sales. All right. Accounts receivable and sales. All right. Accounts receivable works the same way as accounts payable. By the way, its shorthand is AR. But accounts receivable is for customers. Accounts payable is for vendors. Okay, so let's see. Customer bought 1,000 worth of product on account. Okay. Well, I'm just going to go here. You can look at the AED. In fact, we can just put it up and we can know now. Here's revenue. Increase, right? We're increasing revenue. Credit. Perfect. Well, I know this is going to be a debit without looking because my debits have to equal my credits, but let's check anyway. Accounts receivable. Capital? No. Revenue? No. Liability? No. Draw? No. Expense? No. Asset? We know that assets, when they increase, get a debit, and there you go. I think what I will do is I will do a review on the next tutorial and then finish up with getting balances in these accounts. And I think you should have enough to get you through whatever it is you need to get through with your debits and credits. This is a real important, good foundation for accounting. You can't go anywhere without knowing these debits and credits. So I'll see you next time.